So Joseph, why don't we just talk? I don't know if you want to use the camera or not.
Oh
It's
yeah,
your
okay, I can
choice,
use the
no big
camera.
deal. All right, we could be talking heads this morning. So last time we talked, I want to, acknowledge you were bullish risk. You like the S&Ps, and we've had tremendous run. Nice call on that. And you thought we'd have a dollar rally as well, and that's starting to come into play now.
I was
Go
wrong on
ahead.
that, Dale, but you were absolutely right that we'd have to have the Euro rally a little bit before we go back down, and
But
that you totally nailed that. So nice job.
okay, all right. But I mean, now though, this action, it does look like the euro is starting to head down. That it finally completed, and I think your targets are viable now. You were talking about maybe seeing the euro at parity, and one of the reasons was you really think that we want this war, and that too is coming true. There's escalation there in Ukraine. We agreed to send the jets, and the jets. They remind me of a West Side Story, uh, and and now Russia is positioning bombers, nuclear bombers in Belarus. So you still feel like the U.S. is pushing us, America's pushing us into being possibly escalating this from just being a proxy war to being more of a direct conflict between
So
Russia and U.S.
what I read in the news is that the U.S. is now giving fighter jets to Ukraine,
Yeah,
and I think
yeah,
that's very dangerous because it seems like there's a possibility that the Ukraine army may use that to attack Russia, and that's significant escalation. And of
yeah,
course, they promised that they won't do that, or the White House made them promise that they won't do that. But they're in a pretty desperate situation right now. So when you are in a desperate situation, I think all bets are off. So I think the U.S. is definitely playing with fire, and maybe they want an escalation. I don't know. It does seem like
yeah,
they've been pushing for war for some time. We have all these people who come and step in. Even the Chinese come and step in and try to broker peace. But the reporting suggests that that's not acceptable to Washington. So
yeah,
that's
yeah.
something we.
So that's in the background with all the other, noise, data noise, and debt ceiling noise. And do you believe, like everyone else, Joseph, that they will get a deal done, or do you think it could extend um, past the default date, where it's going to take longer than the deadline to get something done?
So I don't really care about the debt ceiling, and that's because
Cool.
the most serious part of the debt ceiling, a default on U.S. Treasury debt, is basically off the table. Now, if the U.S. government were to default on Treasuries, that would be I think, very highly volatile for the markets because you don't really know how investors will handle it. You have a lot of investors who will hold Treasuries who will be defaulted upon, and you don't know if they'll be forced to sell or what they'll do with it. In the same way, you have a lot of people who lend against treasuries as collateral, and you don't really know if the lenders will still be willing to accept defaulted treasuries as collateral. I suspect that they will, but you just don't know. There's a lot of uncertainty there. So that's where I think of that's what I think of as the biggest impact on default be on the markets. But we also
Okay.
know through through a congressional subpoena that in the event that there's a debt ceiling that can't be resolved, the Fed has a plan B, and what they'll do is they'll prioritize payments. And Janet
Okay.
Yellen has also, basically nodded to this as well. So if there is a default, what would happen is that the tax receipts the US government is receiving will first go to pay down Treasury interest, the principal will be rolled over, and then someone else will not get paid. We don't know who that someone else is. I think logically, obviously, they're going to prioritize Social Security as well,
Yeah.
veterans payments as well. It'll probably be, the federal government spends tons and tons of money. So it's probably going to be some kind of big corporation or contractor that is able to take the hit and not as politically sensitive. So
Okay.
at the end of the day, I think if we do go into a prolonged debt ceiling, what will happen is that maybe you'll have Lockheed Martin or someone not get their payments until the debt ceiling gets resolved. But ultimately, they'll get paid. So it's more of a timing issue. When I
Okay.
think of the debt ceiling, the biggest impact, I think, is what it takes to get a debt ceiling resolved. So historically, sometimes that could take significant spending cuts. And if that's the case again, then you could have a downside risks for growth going forward, which might be a good thing because the Fed is
Yeah.
trying to get inflation under control. And to be perfectly honest, we're spending about, say, 5, 6, 7% of GDP in deficit spending, and that's really high for a non-wartime economy. So I think in the medium term, it would be good to have some spending cuts.
Okay. I remember showing this chart to you, and you could tell that I was considering long positions because it's called a ascending triangle. This is a proxy for 20-year treasuries,
Yeah.
TLT. And you didn't, the only thing you said was, all right. You know, which, I know what that means. And so, I didn't buy them. Thank you. So
Yeah.
that meant that you were actually expecting this. Now, I don't know what you think, but I think there's a chance that 20-year treasury yields make a new high here. This low that we had in October was confirmed, momentum and price confirmed. And to me, it looks like they're breaking down.
I
What do you
totally
think?
agree with you. I totally agree with you. So I'm still bearish on rates.
Yeah.
So yields go higher. I think that the 10-year should be trading above 4%. I would think by the end of the year. So I think of this in a couple ways. First, of course, is that I think the market still hasn't fully processed that perhaps the Fed is really more serious about keeping rates higher for longer than expected, and also that there are a lot of structural components that are keeping inflation high. One could be potential escalation of the war, as we talked about, and two, it could just be, I mean, we have this structural labor shortage that's not going
Yes.
away. It's baked in the cake.
Yeah.
We had smaller families in the 80s, and we see this across the world, really. And
Okay.
another factor, and the way that I like to look at any financial asset is just from the perspective of supply and demand. And the
Well,
expectation based upon from the
right.
Treasury's projections is that we're going to have net issuance of Treasury securities between
Being
1.5
average.
1.5 to 2 trillion every year for basically forever.
Who's
Now,
going to buy them? The
yeah,
Fed?
people will buy them. It's just that at what price? You just
Right.
can't print, a couple $1 trillion in treasuries every year and expect rates to stay really low.
Doesn't that crowd out everything? And when you look across the bond spectrum, Joseph, um, corporate and junk are holding up better than sovereigns. Is there a message in that?
Well, there could be. I'm not sure. I mean, I would
Okay.
think that
I
I
mean, the
think there's a
sovereigns
lot.
were best of breed, for a long time. That's where that was the go-to market. And the weird action we're even seeing in the treasury bill market, where people don't even want to go out 3 months. They all
Well,
want to be in 1 month bills.
I'd be
Uh,
cautious about that. That's really just a function of money market funds being
okay.
very, very conservative. So the big investors in that space are super conservative. When you put money in a money market fund, you expect it to be as safe as a deposit at a bank.
Okay.
So what they're
Oh,
doing
well,
is that they're just strategically avoiding any possibility of default, because in the event there's a default, they really don't want that to show up on their books. But I think just a bigger, let's say, 10-year macro view, I think what we're seeing in the world is what happens, periodically throughout history, in that the problem is that the problems are not coming in from the private sector like they did, let's say, in 2008 when we had a big
right.
financial crisis in the private sector. The problems are coming from the public sector, where we really have tremendous mismanagement of our public resources. And so if that's the scenario we're in, and this happens all throughout history, then I think it makes sense for investors to seek refuge out of public sector liability, so out of the debt. So it's kind of a shift. This is like a 10-year thing, more out of the debt market as a flight to safety, and more into things like the private sector assets. And you see this in other countries that are
Like,
very
you mean
badly
like
managed as
Apple?
well.
like
Yes,
Apple and
that's like Apple.
okay,
Look at Argentina stock market, for example. It's like going parabolic because
right.
people don't look at the public sector. They think it's not good, mismanaged, and so they put money elsewhere out of the public sector. Now, this is
Okay.
just like a big picture 10-year thing. It's not something
Yeah.
that's happening right away, but that's
Okay.
how I look at this.
I read at the Fed guy that pretty much this crisis is contained that we had with these banks. But I have to ask you, the cockroach theory, I think all banks are loaded up on paper that was bonds at, 2% 10-year and lowest rate since the last American Civil War. And wouldn't a break, you agree that we could see higher yields? Isn't that going to put more pressure on these banks and take a hit to their assets if they have to mark them to market?
So you're totally right that so on the asset side, some banks are going to be underwater because they made a loan fixed rate and now rates are higher. But when you're thinking about a bank, it's not just about assets, but liabilities as well. So if you want to think that they're, let's say, have a poor net worth or potentially insolvent, you have to look at the asset side, but you also have to look at the liability side. Now, broadly speaking, most banks, their liabilities are going to be deposits. So how do you think about a deposit? Now, on one extreme, isn't it like an overnight loan to the bank? So anytime, any day, you can go up, show up at a bank and take all your money out, right? So
Yeah.
in a sense, if everyone did that, the bank would go bust because all their unrealized losses would have to be realized as they sold them to make investor payments to meet withdrawals. But
Right.
in practice, though, I mean, at least speaking for myself, I never go to the bank every day and take out all my money at the same time.
Look
So,
how easy it is for them, for the government to be able to implement um,
okay, so
a limited amount that everyone. I mean, to help avoid this, that
what,
there'll
wait,
be some kind
just
of
a
rule.
broader point.
You know,
So,
they. Okay, go ahead.
so in practice, when you have money in a bank, you basically keep it there for some time. In practice, a deposit isn't a overnight liability, it's a term liability. It's just that you don't know what the term is, and banks try really hard to make that term as long as possible, to make that deposit as sticky as possible. And they do
Right.
things like, let's say, give you good customer service, or maybe try to tie you into their ecosystem by offering credit cards or mortgages or wealth management services and so forth. You
Got
know,
it.
kind of like Apple locking into their customers into the Apple ecosystem. And
Okay.
there's a huge, all sorts of ways that they try to lock you in to their bank to make that deposit liability uh, a term loan to the bank. What Silicon Valley Bank did was they basically went to these founders and who could not get loans from anywhere else and said that, hey, we'll give you a loan on the condition that we're your bank. And First
Yeah.
Republic then went around and found really rich people and said, we're going to give you really cheap mortgage loans, but on one condition, we're your bank. And those strategies were not successful in trying to make deposits sticky. But usually speaking, just historically, I think banks are pretty successful in making their deposits sticky, if only for the fact that most people just don't care that much about how much interest they receive.
Okay. Do you think that there's a chance that it'll be an idea that there'll be a certain amount, limit the amount that bank customers can withdraw during a certain period? Do you think that's going to go anywhere? There's talk
No,
about
no,
that.
I don't think I don't think the banking sector is unhealthy. I think the banking sector is fine. When I look at, and so if they did have deposit limits, I think that's a clumsy way of doing it. I'm not sure it would help because then everyone would go and get cash out immediately, even if
Right.
they didn't need it, because they would be afraid they wouldn't be able to withdraw later. Now, just taking a step back, if I look at the banks that failed, Silvergate, First Republic, Signature, Silicon Valley Bank, those are all banks that their client base was heavily speculative tech. We all know that over the past couple of years, speculative tech, crypto imploded, and it seems like they took down banks that heavily depended upon them.
Right. Um, what did you glean out of the I think it was just a presentation by both Powell and Bernanke. They got together last week, and I don't know who they were addressing, but did you glean anything out of the discussion of their frat party?
So I hear that, and I think for them, for Chair Powell, June hike is not a done deal. So
Okay.
throughout the FOMC, we have two voting members come out openly for a June hike, Governor Bowman and voting member Logan of FRB Dallas. Powell, not committed. Future Vice Chair Jefferson, not committed. So they're going to look at they're going to be, as they say, data dependent. So if we have a hot CPI or a hot NFP print next month, I think June 25 is on the table.
You still like risk here, Joseph, or was
No,
that
I'm
enough?
really bearish. I'm looking for a 10% correction in the Qs, and for the S&P a little bit less. So
Okay.
I look at the world through the lens of, I think the biggest driver of assets is central bank policy. Now the market, I
Rates.
think, is rates. So the market is still pricing, I think, too big a
Right.
possibility of rate cuts in the coming months. I think that's completely unwarranted, and so I realize that it looks like the technical picture is good, but when I look across the rate universe, I think I see the rates markets 10-year becoming more aware that rates are going to stay higher for longer. I see the dollar strengthening, and I think that some of the more speculative aspects of the market, some of the like tech, which, well, I think tech equities are usually the last to know. I think they are getting ahead of themselves. I don't think they'll crash, but I think we are due for a correction here.
Yeah, here's Microsoft. So, there's been about, you mentioned the Qs, and the Qs are what, 100 stocks in NASDAQ? Yeah, they're 100. And within the 100, it's mainly, Apple, Microsoft, about 8 of them. And yeah, this is the move in Microsoft, and
Yeah.
Apple knocking at all-time highs. So anyway, look, you buy straw hats in winter, and when everyone's lining up to buy something, sell it to them, right? And people are lining up because a lot of people think a narrative works all the time, and you're a trader too. And your narrative is that public assets will be where money will go. And I brought up Apple, but it doesn't mean that Apple can't pull back to, 150, 160. You could have pullbacks in those areas. And the euro, Joseph, with what's going on now, and the euro finally topped up around that 110. I think that there's a possibility that you could get your area. You see this blue line down here? Comes
Yeah,
in around
103.
comes in around, well, yeah, this is where it might
Okay.
stop.
Mm-hmm.
But this is a trend line it broke from the highs in 2021. And
Has
that
to
comes
test
in
that, right?
near a buck.
Hmm.
And I know you didn't ride the gold and silver train. You were looking for cheaper prices.
Yeah,
You think you're going to get them now with the dollar
I think
rally?
so. I think so. Yeah. So
Okay.
listen, broader picture.
Yeah.
I think gold and silver and all of these, I think more tangible assets are okay, but I think that we're at the beginning of a dollar rally. As again, like I mentioned, I view the world through the lens of rates, and I don't like that the market has such a high probability of rate cuts later in the year. I want to see that come out before I feel more comfortable buying risk assets and gold and silver.
Okay. What do you think would be the catalyst for that coming out if it's not going to be the Fed? Could it be the debt ceiling? Then, and let me ask you this, could a debt ceiling problem be great cover for why the economy is going to be lousy next year? Could blame it on Congress. It could be the Republicans will blame the Democrats, and the Democrats will blame the Republicans, and the Fed could say, maybe it wasn't all our policy that we have a weak economy in 2024. If we hadn't have gone through, if we just passed a clean debt ceiling, maybe we wouldn't have been here. It wasn't all us.
So the Fed never blames Congress, but Congress can blame the Fed. So the Fed is kind of like their punching bag, right? if they're
Yeah,
punching back.
okay. All right, okay. So the Fed will take it on the chin if we have a recession next
Yes.
year. Do you think we will next year, Joseph?
Yes, I do. Not this year, but yes, next year I think we will.
Okay, and hard landing,
No,
soft.
I don't think we'll have a hard landing. It's possible depending on how big of a spending cuts we get. If we have huge spending cuts, I think we could get a
Yeah.
hard landing. But
Okay.
I think that's the big variable that I'm not sure how these negotiations would turn out.
Okay.
But broadly speaking, so even though the Fed has hiked overnight rates to 5%, if you look at the really economic sensitive rates, like the 10-year, we're still like
Oh,
3.75. Inflation is
yeah.
5%. It doesn't seem like it's the cuts are fully having an impact on the real economy. We see very interest rate sensitive sectors like housing, for example,
They're blow.
stabilizing.
They're parabolic. The housing stocks.
Yeah, the home
So
builders are. Yeah,
yeah.
so that tells you a lot. It tells you, first of all, that home prices are going to be stable. Why? Because inventory is low. No one wants to
Right.
sell their old homes. And so that means if you want to buy a home, you got to go to a home builder. Home builders stocks are supported, but also home prices as well, because there's not as much supply. And that kind of takes away a major channel of monetary policy. That means there won't be big construction layoffs because the home builders are doing well. And that also means that there's not going to be a big negative wealth effect because your home prices are not going to go down that much.
Yeah, you think about it, the market's gone up while the 10 years gone from 330 to 375 and a half. And that's called, they could both go up together for a while with what's called disintermediation, correct? Where risk could go up with yields going up until you get to a tipping point. And what do you think it'll be? 390?
I still think yields 10-year goes above 4% by the end of the year. And I think that will not be good for risk. I don't think
Okay.
we're going to crash, but I do think we correct.
Okay, because this does look like a consolidation before another move up, like a flag or a triangle, which implies another move to the upside. So 390 is what this little formation measured. Over 390, I think it's going to be a little panicky there, don't you?
I think some people, I want to say that, but then over the past few days, we see the 10-year steadily
Yeah.
going higher, but we also see like supposedly the more, let's say, uh, interest rate
Interest sensitive.
sensitive stocks like
Yeah.
techs, they also go higher. So it doesn't seem like that relationship is there at the moment.
Right. That's in the 87, we had bonds crashing. Okay. Yields were going up, and the market kept blowing off to the upside until there was a tipping point. And then the bonds rallied huge, and we had a crash. So it could last for a while with rates and the market going up, but it does usually reconnect.
Yeah, I think they eventually will. Um, but
So
that's why
what's
I'm
your so what's
kind
your
of
last most
cautious.
recent article that you're putting out? And I do appreciate um, getting your emails and then being able to go to your
Yeah.
site, even though
So
I don't understand, a lot of these things like LCL or R, but you explain them well.
so one thing I'm thinking about right now is just how long do you have to have, how long does high inflation feed into inflation expectations? We've had 2 years of inflation above 5%. Now, eventually that's going to impact how people think of the future inflation. Now, I don't actually know if inflation expectations cause inflation, but I know that the Fed thinks it that way. And that's going to make it more urgent for them to lean more hawkish because they want to get actual inflation down because they're afraid that high actual inflation would lead to higher inflation expectations. And I think you're hearing some commentary from Fed people being more concerned about that. So that's another reason why I can see I'm more biased towards a higher for longer stance in rates. That is, again, not fully priced into the market.
Because there are products out there, Joseph. I notice them in my everyday life. Certain products have come back down, like egg prices, but there are certain products that I have a hard time understanding why they're up 30–40% in price. It's almost like it's not because of what the contents are or what it costs to produce them. It almost seems like it's done just because it can be, to raise prices like that. Is that what
Yeah,
you're talking
definitely.
about?
Well, the retailers, they definitely are saying that they feel like they have pricing power, so they're willing to raise prices even though it costs them some volume, because that's how they maximize their profit. So that's definitely happening. Uh, the fact is that a lot of industries aren't very competitive. So you have this kind of oligopoly like system where some retailers have a lot more pricing power than you would think.
Okay. All right. Well, Joseph, again, thanks for the clarity. Fed's not going to move. Yields are still going higher, and be careful out there about risk. Maybe it's more about the return of capital than the return on capital, unless you're a trader.
Sounds good.
Right,
Thanks for
buddy?
inviting me, guys.
All right. So everyone, Joseph Yang, follow him at Fed Guy 12 and go to his website if you want to learn about what Joseph knows. He shares it. You want to take an online course in the Fed, he offers a few of those, and you could find him at fedguy.com. Great to talk to you again, Joseph. We'll catch up in the summer.
Yeah, I'll talk to you guys then. Happy
All
trading.
right. I hope it's more than 10%. The decline.
Well, I'm really short, so I hope so too.
All right.
All right.
Joseph Wang, everybody. Thank you, my trading warrior brother. That's
Bye.
a wrap. That's a wrap, everyone. You could join the team in about 17 minutes, everyone. Have a great day. See you tomorrow. He's a great guy, isn't he? I learned from him, and I wish I could be as calm as him. Anyway, so here's a nervous coach signing off, telling you while I'm biting my nails not to just count your pips, count your blessings. And I'll see you all tomorrow, God willing. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.